In this week's update, my goodness, where did the panic go? What the last 2 weeks have taught us about bull markets, and gold breaks $2,500. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. All right, very interesting week. It's as though what happened 2 weeks ago was just a bit of an aberration, a bit of a thought bubble, and didn't really occur because everything has gone back to normal very, very quickly, and I don't think anyone expected to see that. This is a really, really strong lesson from the last 2 weeks, and that is particularly around stocks that you own, that you have a long-term expectation for, and that you have a very high conviction around, that whatever happens in the short term, prices will bounce back and they will progress on to a higher level. So that's the sort of stocks that I'm talking about. And the lesson is that really you should be reluctant to sell even part of it, and you definitely shouldn't sell all of it with the intention of trying to buy back in, because if they are stocks of that ilk that you've got a very high conviction and you want to own for the next 5 or 10 years, then you would, if you got out, you'd definitely want to get back in, wouldn't you? But what the last 2 weeks again has demonstrated very clearly is that it's almost impossible to do. And I'll come back to that. So I really defy anyone to exit at a point and then re-enter at a lower price, except on a rare lucky occasion, because again, by definition, the stocks that you have very high conviction around aren't likely to keep falling and falling. They're likely to fall less and bounce back sooner. So why wouldn't you just try and get through that period, be it a week, as we've just seen, or a month, or maybe even 3 months? I mean, who cares if you're investing for the next 10, 20, 30 years? Then who cares if it's down for a month? Why would you try and sidestep that and run the risk of not getting back in? It just makes no sense. But of course, we do it at the time because psychologically our emotions are in control. We do what we think is right, what feels right, but it doesn't work. It's too hard to do. So what does that lesson mean for our investing process? Well, first of all, you've got to have one. You've got to have an investing process. You've got to have a plan. You've got to know what you want the composition of your portfolio to look like in broad terms, so that you're building something that you want, not just something that happens by chance. You need to have a process around how you buy, what you buy, and how you buy it. You definitely need to have a process around how you take profit or how you take exits for losses, and most people don't. And it's the thing that nearly everyone struggles with, and it's no wonder, because no one has any structure to how they do it. They just play it as it comes, and inevitably the only time they think about exiting is when prices are moving quickly to the downside, and that is the very worst time that you should be making decisions about what to sell, because your emotions are just going to be in the way. So you need to do whatever you need to do to trust your process when markets become unstable, and you need to do it in advance, doing it as it's unfolding. You know, if you didn't have your process very clearly in your mind 2 weeks ago, you can't make it up on the run. You'll be consumed and influenced by the media, by all the voices in your head, by all your past experiences, and chances are you'll make pretty wobbly decisions. And those decisions will lead you to commit the cardinal investor's sin, and that's you regularly buy too high because you chase prices when you're comfortable, and you sell low because you sell out in a panic because you don't have an exit strategy. And you just do it year after year after year, and you wonder why you get substandard results. So the last 2 weeks, if you ever needed a clear lesson in the need for a clear process and an environment where you can reliably stick to that process, then I don't know what will do it, to be honest. So where to from here for markets? We'll get to the charts in just a minute. But there's every reason to expect that the rotation in the US from a small number of big tech stocks related to artificial intelligence and data centers into all sorts of other parts of the market where we've got small and mid-cap stocks that are equally high growth. Some of them are the next level down in AI aspirations and services. And they're areas where valuations are far more appealing, and yet the growth is still tremendous over the long term. So there's every reason to expect that rotation will continue. Secondly, I think we can now feel more comfortable that a continued large sell-off in technology is highly unlikely. There could be some continued downward pressure, but that's a different thing altogether. Now, I say that except for another black swan event. And, there are plenty of geopolitical flashpoints around the world, but putting that aside, and also the unknown of, we started to see a bit of an unwinding of the yen carry trade. Will life just go back to normal there, or will that continue in some form? Don't know. But putting aside another black swan event, I think the worst we might see is a bit of selling pressure on technology, but nothing in terms of a large sell-off. So it certainly creates the environment where really good stocks can perform. That's the message. And that's where the opportunity is. And in America, there are just hundreds of high-growth stocks trading at attractive valuations. Those high-growth situations are highly probable to unfold because they're swinging off the tailwinds that are virtually unstoppable. Irrespective of what the global majors do with data center development, there's a lot of chatter about the fact they may have to pull back on the speed of growth, and that may happen. But there are many other parts that will still progress and provide opportunities. So there are hundreds of possibilities in related areas in America. There aren't hundreds in Australia, but there is still a very healthy number of Australian small and mid-cap stocks offering high growth, highly assured growth, and quite attractive valuations. So do not be put off by what indices are doing. Do not be put off by the media in terms of how they perceive the risk, because 99% of the media that writes this stuff really don't understand, I think, a lot of the time what they're writing. They don't understand markets. They don't have decades of history in markets. They haven't been to this movie theatre dozens and dozens of times. So the task for investors is to build a big list. If you want to own 20 stocks, then have a big list of 40 or 50 targets. Don't just have a list of 20 targets, because inevitably you will feel compelled to chase a price because you've got your heart set on owning that stock. It's just all psychology that you can overcome. So build a big list and let them come to you on your terms. Now, if you don't know how to do that, or you don't have the time or the inclination to do it, which is most people, the vast majority of people just should not be doing this because they're going to be just throwing darts at a board. So, get some assistance with that, but build a list, understand what is an attractive entry price, and just let them come to you on your terms. And forget about owning any particular stock. What you want to own is a stock that's going to make you a significant amount of money with a low degree of risk. I don't care what it is. I don't have to own stock XYZ. A stock is just a conduit to create wealth, and you need to see it that way. All right, turning to America now, the S&P was up 4% across the week, so a very robust rebound. The NASDAQ was up 5.3%. The S&P, I think, is within about 2% of its all-time highs. That's why, after the 2 weeks we've had, one exceedingly fearful and volatile week to the downside, followed by a very positive week to the upside. The equal weight S&P rose to 2.5. The Russell for small caps rose 3%. So normality returning just as abruptly as it left the building. Now, this was the strongest week for the S&P of 2024. Quite extraordinary. And I certainly couldn't say that last Sunday. But what turned it around, of course, was the market overreacted to a single data point and a few other things. But essentially, it was a single data point on jobs and unemployment that triggered what happened. And all it took was one data point confirmed by another data point that just turned it all around and made people realise that this had been a complete overreaction. The US dollar continued down, obviously, as the expectations for rate cuts and the possibility of a 50 basis point rate cut just gets stronger and stronger hold on the market, and we'll find out next month. The 10-year yield slipped back to 3.88. We'd had a massive spike in the VIX to 65, which was just ridiculous, because anything over 40 or 50 is the sort of thing that you see during the GFC or during COVID, massive financial upheaval events. And last week, the week before last, was not that. It wasn't remotely that. So for the VIX to go to 65 was complete cuckoo land. And this would be, I think I'd be on pretty safe ground to say this would be the fastest decline in the VIX from an excessive level to really a below normal level. 14.8 brings us back to the absolute lower end of where the VIX has been all year, when things were calm and stable. And for that all to happen in the space of 10 days is quite extraordinary. All right, let's go and look at some charts now. This is the SPY, the S&P 500 on a weekly basis. So massive gap down and then a strong recovery, but only back to the point of breakdown. But the really, really good follow-up was the key. The equal weight S&P on a weekly basis, not quite as strong, but it was not nearly as strong to the downside either. And there's the Russell on a daily chart with a nice gap up into Thursday and Friday as market confidence returned. The NASDAQ also on a daily chart, gaps everywhere. Gaps into Tuesday, Wednesday, Thursday and Friday. So a pretty good finish. This is semiconductors versus the S&P 500, and huge sell-off that was already underway before the events of August 5. So that increased what was already a big shift in sentiment as big tech got sold off. But we saw a pretty strong rebound. Now, I do not expect this just to go back up and life to completely return to normal and big tech to take over leadership again. I don't think that's going to happen. I think we're now in for a period where big tech will stop outperforming. They may not fall in price, but I think the strong upward trends will probably go into consolidation for a period, and they're overdue, and that would be healthy. Let's look at it on a sector basis. Very tellingly, the big leaders over the last week or two have been consumer staples, which is exactly what you'd expect. Healthcare, to a degree, is what you'd expect. Communication services is still surprisingly high, so the market is still prepared to embrace some of the more aggressive sectors of the market. The banks rebounded very strongly from the smashing that they took, which, was expected with something like the unwinding of the yen carry trade. You would expect that to impact banks. Once the penny dropped that wasn't going to happen, the banks came back very, very hard. And then we saw, technology is sort of in the middle, and then materials, and then we've got energy and consumer discretionary. But I would say with consumer discretionary, whilst it got really, really smashed 2 weeks ago, the consumer is still, probably moving now to being a little bit more discerning. But the data shows that the consumer is still confident. Buying is still improving. And why is that important? It's very important because consumer spending is 70% of the US GDP. And US GDP being healthy is good for the rest of the world. So whilst you may not care what the US consumer is doing, it is important for our market. So that's what happened there. Look at Australia. Finance, again, bounced back very strongly. Healthcare, information technology, good to see, really roared back very quickly, and materials and energy very much brought up the rear. And as we'll see in a minute, materials being buffeted around by several things. So let's move to that chart. Aussie dollar bounced to just over 66. The ASX 200 up 2.5%. I would expect we'll probably see some further mild gains on Monday, but it was really materials that was really the drag on our ASX 200. Couple of factors. The iron ore price has slipped below 100, down into the low 90s. And that, of course, affected the big three, BHP, Rio and Fortescue. So that was a significant drag. And there is also the high likelihood that there'll be a strike at the Escondida mine, which is a BHP in Brazil. And that means lower revenues, lower profits. And so BHP and Rio was sold down. So that is the story of the Australian market. But look, there's just some wonderful opportunities. And the Insiders Club core portfolio, which carries a lot of small and mid-cap growth stocks in Australia, did have a very, very encouraging week. Turning now to precious metals, gold was up $76 to 2,509. So gold not really behaving in the way that you would have expected. When the panic was on, gold didn't shoot up. When some of the geopolitical events were really at their highest, gold didn't shoot up. But towards the end of the week, and particularly Friday, it certainly did. It was a big up session on Friday. If we look at that in Australian dollars, 3766, extremely profitable territory. And the trend for gold, as we'll see in a minute, is very clear. With precious metal stocks, particularly in Australia, because there's nothing terribly attractive outside a couple of the bigger gold stocks in North America. But in Australia, there certainly are some good ones, but you still need to buy the dips. Still, some prudent process is required. All right, let's just have a quick look at the currencies. There's the US dollar index, quite a sharp fall on Friday, and the Australian dollar, of course, heading in the opposite direction. ASX 200 on a weekly chart looked like that, so we're not that far off all-time highs. If we look at, start with silver, nice rebound, had a little peak back above this support and resistance line, but didn't really follow through in the same way that we saw gold. So when we have a look at the gold price, there's the weekly chart, so looking very, very strong. And you can see that the uptrend is very clear. Daily basis, gold finished Friday very strongly. So silver's just really struggling to keep up with the market. It's really hard to understand the dynamics around the silver market. And in Australian dollar terms, we kicked up a little bit on Friday, and that was sort of held back, of course, because the Australian dollar rose, held that back. All right, turning to other commodities now, copper moved up back above $4 a pound, which is good to see. Nickel didn't do much. So we had a dip under $4 for copper. Talked about this last week. This was a critical support level. We needed to bounce, and we did. But this was hardly an impressive bounce. And copper remains very disappointing, as just about all critical metals do. I think the bounce was more about the declining US dollar. So I'm not excited about what happened in copper at all. It should be doing far better. It's defying logic. It really is. The market is doing what it does. And you've got to pay more attention to the market action than you do to the logic. West Texas Intermediate crude, these just a little bit, wasn't much, 10 or 20 cents down to 76. There's slight rebound off support in the copper chart. But as I said, mostly currency. I think there's anything else much driving it at the moment. Final thoughts. I'm just going to go through what I said last week because I struggled to think about what could I say that would be helpful, and I can't think of anything more appropriate than what I said last week. If you want to get better long-term results and significantly better long-term results, you've got to stop buying high and selling low. So you need to take a good hard look at what you did 2 weeks ago. And over the last 2 weeks, it's just such a powerful lesson. in what to do and what not to do. You need to tune out the noise. By all means, read things, but underreact to what you read, because I read some things in the last 2 weeks that I just burst out laughing. They were so stupid, written by people who should know better. So tune out the noise. Only pursue proven quality stocks, high growth stocks with a high probability of growing earnings and growing revenue for years to come. There's far more out there than you need. So why would you buy anything else? It's just, again, that defies any sort of sensible logic to me. Just focus on stocks that are almost certain to give you what you want. Don't buy something that you like. Liking a stock has got absolutely nothing to do with it. Forget the maybes, forget the likes, forget the maybes. Just go with the highest quality you can find. And if you don't know how to do that, then hitch your wagon to someone who does. Ensure that the research that's done is thorough. And the reality is most people do not have the time or the knowledge or the inclination to do the research thoroughly enough, to be immersed in the market, to put it all in context. And then finally, give the story time to unfold. Don't react with high quality stocks to what happened 2 weeks ago. Markets misprice quality stocks all the time over the short term. So why react to it? Because the chances of you getting back in at a lower price are almost nil. So why would you get out in the first place? Just to make yourself feel a bit calmer for a few days or a few weeks. It's not the way good investors work. Portfolio analyst last week, no surprise. We talked about managing in tough periods. And I think there were some just fabulous lessons to learn last week. And we also focused on future significant wealth compounders. Periods like we had 2 weeks ago, when you really want to step up and learn, and when you want to step up and be doing the opposite in the market to what your emotions make you feel like doing. It's where the real advantage comes from. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you as usual next Sunday. Cheers.